Thanks for joining David, Kevin, and myself for the market update for the month of December. We hope all of you had a fantastic holiday season. I know we all did. 2025 was a very interesting year. It reminds us why we can't listen to headlines. We had so much going on. We had inflation, tariffs, geopolitical conflicts. Yet overall, the market was very solid for 2025. I'm going to pass you over to the guys and they're going to give you an update of everything that happened in December. But as always, if you need any help, want to review anything, please don't hesitate to give any of us a call. Take care.
Looking back at the month of December for 2025, overall equity markets were mixed but generally positive. The US stock market, as measured by the S&P 500, was off slightly at 0.2% once we convert to Canadian dollars. The Canadian market, as measured by the S&P TSX, was positive 2.15% on the month. And the European and Asia Pacific markets, as measured by the MSCI EAFE, rose slightly by 0.82% for the month of December.
2025 was a year defined by resilience. It certainly wasn't an easy year for investors, but for those who could stay the course, it ultimately ended up being a rewarding year. Looking back, we had concerns around tariffs, we had concerns around inflation, valuations in the AI technology space. We've had geopolitical conflicts all throughout this year. And so there were tons of reasons for investors to fret or exit the markets. But for those who could remain patient and rode out the ups and downs of this year, ultimately, we were rewarded once again with a pretty solid year in 2025.
Throughout the year, we consistently saw earnings growth replace valuation expansion as the primary driver of equity markets throughout the year, as compared to 2024. We saw corporate profitability remain resilient throughout the year, and even though economic growth did slow, it didn't stall at any point. And this earnings-led environment is typically healthier and much more sustainable than rallies driven purely by investor enthusiasm. In other words, markets are growing, and not just blindly, they're being backed up by fundamentals.
Market leadership continued to remain pretty concentrated, especially in the US stock market, led in large part by the so-called Magnificent Seven stocks: Microsoft, Amazon, Apple, Google, Tesla, Meta, and Nvidia. These AI beneficiary stocks continue to have tremendous earnings growth, like Kevin said, but also have been experienced multiple expansion as investors are increasingly willing to pay up for that tremendous earnings growth that most of these stocks exhibit. But we've also seen the benefit of diversification in 2025 as well, as international markets, particularly in Europe, and here at home in Canada, the Canadian stock market actually outperformed the US stock market in 2025. So once again, diversification actually worked much better in 2025 than it did in 2024, where US equity markets were the dominant equity market globally. And we continue to see valuations be a little bit more attractive in Europe developed, in Asia Pacific markets, and even still here in Canada, as compared to the US market, particularly in those mega cap names. So we expect that 2026, we will continue to see broadening of the equity market rally to other lower valuation companies continuing to participate in earnings growth.
By late 2025, we could see that central banks had clearly shifted from trying to fight inflation aggressively to carefully supporting economic stability. And that even though interest rates aren't down at the ultra-low levels that we may have seen in, say, 2020, the direction of travel does matter. Markets tend to respond positively when they can see rate hikes are firmly in the rearview mirror, and that even modest easing from here on out can promote liquidity, confidence, and positive markets.
Heading into 2026, it's clear that markets are not cheap by historical standards. In fact, valuations are a little bit higher than average, particularly in the US market, and in particular, those AI-related technology stocks like the Magnificent Seven that we mentioned earlier. So What is an investor to do in terms of positioning heading into 2026? Well, higher than average valuations have not historically been a useful market timing tool. Just because markets are at record highs and valuations are a little bit stretched doesn't mean that that can't continue for months, even years. So again, we continue to have a preference for, diversification among geographies, among the types of sectors that we're in, not being overly concentrated in those slightly more overvalued AI-related technology stocks, although you probably do want to have some exposure to those, like many client portfolios certainly do. And ultimately, remember that a lot of the themes that coincide with elevated valuations, like strong earnings growth, technological innovation, i.e. AI, in this instance, and earning and strong economic fundamentals are all present today. And so that gives us some confidence heading into 2026 that this market should continue to move forward, albeit there's going to be other things that pop up this year, just like there were last year, that could cause some worry for the market. Of course, that's no different. But ultimately, those concerns, the fact that the world remains a messy and chaotic place, is something that investors like us have to just accept. It's part of the price that we all pay in order to get those long-term growth rates that equity markets have provided long-term and certainly in recent years.
As always, if you do have any questions about your portfolio or you'd like to review any of it with us, feel free to give Harry, David, or myself a call anytime.
All the best for 2026, and we'll talk to you soon.
Take care.